Hello, and welcome to Demystifying the USALI. In this 6-video course, we will provide an overview of the Uniform Systems of Account for the Lodging Industry, or the USALI 11th edition. In this first of 6 videos, we will discuss the following. First, we will take a quick historical overview of the USALI. Next, we highlight the contents of the book. Finally, we will begin our discussion into Part 1 of the USALI with an overview of the operating statements. Let's begin with the USALI story. Published in 1926, the first USALI book might seem distant, but it holds a significant historical impact. The USALI's authors were pioneers in an evolving hospitality realm, capturing a time when the hotel business was primarily bricks and mortar. And committees represented iconic hotels such as the Hotel Pennsylvania and Waldorf Astoria. As the industry transformed, the USALI adapted. The 5th revised edition in 1952 featured departments like cigar stand and candy and soda shop. Shifts from the bricks and mortar model led to the 7th revised edition in 1977, and expanding its committee to reflect a diversifying landscape with companies like Sheraton and Hilton. The 9th revised edition in 1996 embraced global relevance, including participation from international bodies. And the 10th edition in 2006 saw a merger with the Uniform Systems for Small Hotels. The 11th revised edition, published in 2014, incorporated technological advancements and acknowledged that operators and owners have different information needs. The revision to the USALI book is led by the Global Finance Committee, sponsored by HFTP Hospitality Financial and Technology Professionals and the American Hotel and Lodging Association. This committee represents ownership groups, operators, asset managers, academic institutions, accounting firms, and consulting firms. The committee is tasked with much responsibility as they consider the need for changes and the impact on the industry. The copyright to the USALI was purchased in 2018 by Hospitality Financial and Technology Professionals. What does the future hold? Starting from October 2019, the revision process for a new 12th edition has been meticulously conducted. Before unveiling the latest edition, HFTP has actively engaged prominent figures within the industry to partake in the assessment of preliminary drafts. Upon a complete review, the 12th edition will be published in early 2024 and will go into effect in early 2025. Why does using the USALI matter? It creates standards that similar businesses can follow, making it easier to compare performance across different companies or a company's various ventures. Most importantly, it helps managers understand their operations better and improve their skills as business managers. Now that you understand a bit of the history and purpose of the USALI, let's look at how the book is laid out. The book begins with a preface, most of which we just discussed, followed by a quick overview of the current edition and select changes from the previous edition. An introduction, and then 5 sections follow. The first of the 5 sections of the USALI 11th edition is Operating Statements. Section 2 follows with Financial Statements. Then Section 3, Financial Ratios and Operating Metrics. Section 4 provides the Revenue and Expense Guide. And Section 5 discusses gross versus net reporting. Not all USALI books will have an addendum, but there were changes after the initial publication was approved, and these are noted in the addendum. Let's now take a look at the beginning of Section 1, which focuses on the operating statements. Here we will look at the format for the summary operating statement. The type of information that is included in each of the major categories of the summary statement. We will also highlight what is not included in the summary operating statements. Here is an example of the operator's summary operating statement format, found in the USALI 11th edition. 2 versions of the summary operating statement exist, one for operators and one for owners. Both aim to offer management insights into operation outcomes and make it easier to compare these results among different lodging entities. If they both provide operating results, why is there a difference? Well, the statement for the operator or manager of the hotel will stop at the line entitled EBITDA after replacement reserve. EBITDA is earnings before interest, taxes, depreciation, and amortization. Interest is the interest on debt or borrowed money. Taxes are federal income taxes, and depreciation and amortization are non-cash expenses that represent the value of an asset that has been consumed. This profit level is before any of these items are deducted. The owner's statement deducts all of these and reflects the final net income for the hotel. Nothing more can be deducted from net income. It is, as we say, the bottom line. Our focus will be on the operator's report, so the statement we will be reviewing will stop at EBITDA after replacement reserve. The summary operating statement summarizes the operating result of all the hotel's operations. We begin with operating revenue, followed by departmental expenses related to those operating departments. After that comes undistributed expenses, then management fees, non-operating income and expenses, and finally replacement reserve. Ending with EBITDA after replacement reserve. The summary operating statement also includes some key statistics for the hotel, as is demonstrated in this chart. The information provided are the number of rooms available to sell, the rooms sold, and together, these will help to calculate the occupancy percentage. Following the information on volume comes the pricing. ADR stands for average daily rate, the average amount charged for each room sold. Then there is RevPAR, which is revenue per available room, and total RevPAR, which is total hotel revenue divided by available rooms. We will review these in the section that covers ratios and operating metrics. What type of information will we find in the summary operating statements? The first part of the summary operating statement is the operating revenues. In a uniform system of accounts formatted operating statement, the room's revenue section comes first, followed by food and beverage, other operated departments, and miscellaneous income. Other operated departments are those which are not generating a significant portion of the revenue. They are all combined here on the summary page. Miscellaneous income is revenue recorded on a net basis, revenue for commissions or cancellation fees. Most of the items recorded in this department have no cost associated and may not require much oversight from the hotel. Departmental expenses follow for the operating departments. Notice that there is a line item for each one, except miscellaneous income. As mentioned, these are inflows or revenue sources that do not have associated expenses. Again, commissions are a good example. Let's say you get a commission from the limo company that is used by the guests based on referral. These commissions would be recorded in miscellaneous income. Total operating revenue less total departmental expenses equals total departmental profit. So, the revenues for the operated departments less the associated expenses for those departments yield us departmental profit. Undistributed operating expenses follow the departmental profit line. These are costs that affect the entire hotel but cannot be distributed in a manner that is equitable. For example, the general manager's salary is in the administrative and general department. The general manager runs the entire hotel, but the salary stays in one place. Information and Telecommunications Systems was a department that was added in the 11th edition. Prior to that, all these costs were within the departments in which they were incurred. Technology has become a significant cost in our industry, so these have been segregated to this department to understand the total spend. This was one reason for the 11th edition change. The change in technology forced a different way to look at the cost. Sales and marketing is related to promoting the hotel to generate more business. Property operation and maintenance is the regular upkeep of the asset. not new construction or additions. Utilities are the costs of electricity, water, gas, etc. The total undistributed expenses are deducted from departmental profit to arrive at gross operating profit, also known as GOP. This line item is crucial for most managers as it represents the profit that can be controlled by management. All line items above this contribute to the hotel's revenue and expenses, which the management team can manage. Below this line, there are costs that management may have limited or no control over. Management fees are the fees paid to the operator of the hotel. If you, as the owner, lack experience in running hotels, you might hire a management company to handle operations on your behalf. These fees are typically a percentage of total operating revenue. An incentive fee might also be tied to certain profitability thresholds, varying from company to company and owner to owner. Management fees cover the overall hotel operation and are separate from fees associated with managing a specific department. Those fees would be reflected in that department. GOP minus management fees equal income before non-operating income and expenses. The non-operating income and expense section is unique as it combines both income and expenses. The expenses here include costs that are not subject to management fees and may not be under the direct oversight of the hotel's management. Expenses related to rent represent the cost of leasing property and equipment, with operating leases and capital leases both accounted for here. Property and other taxes include taxes related to the hotel's assets, like property taxes and gross receipts taxes. Insurance covers property and liability insurance, while other reflects gains or losses on the sale of long-term assets. All of these items are used to calculate total non-operating income and expenses, which are then deducted from income before non-operating income and expenses to obtain EBITDA. The next line item is replacement reserve. This is the amount set aside for refurbishing the property to maintain its revenue-generating capabilities. It could be a contractual obligation or required by the bank for a loan. Replacement reserve is reflected as a provision on the profit and loss statement and is a liability on the balance sheet. EBITDA less replacement reserve equals EBITDA less replacement reserve, which is the last line on the operator's statement. Now you should have a good understanding of the information provided in a USALI summary operating statement format for both the operator and the owner. Some items found in financial reporting are not in the USALI as it is a management reporting tool. What is not included in the reports are interest expense from loans or other financing, federal income taxes, depreciation expense, and amortization expense. That takes us to the end of this presentation. The next video will provide a bit more insight into Section 1, which covers more on the operating statements. The second video will highlight the contents of some of the departmental schedules. You should now have a better understanding so you can move forward.